in terms of a perspective on investing. So if I do private equity, 9 times out of 10, I got to be financially conscious in terms of seeing long term. I have to know that I may have an investment that doesn't do anything for 5 or 10 years, or it's just going to suck up cash for quite a while. But eventually, I believe at the end, there's like some gold at the end of the rainbow. But if you have people that gave you money who can pull their cash anytime they want and force me to sell anytime, then that can create a problem, because what happens is that people tend to want their money back at the absolute worst times. No matter how much I tell everybody that downturns are the perfect time to invest, doesn't matter. People aren't going to listen. Everybody's going to run and grab their money. Fear takes over. This is why we have a Black financial therapy department in the Black Business School, because you have to work on financial anxiety. We bring therapists in to help you with that. That's what my wife does, right? Because so basically, fear causes people to say, "Oh my God, everything's going south. I better get my money while I can." And so they're going to come get their money, and not only are they coming to pull their money out, but they're pulling it out at the absolute worst time, right? So then what that does is, if you're the fund manager, you got to go sell assets into a dark market. So it's raining outside and somebody says, "No, I need you to go outside and get my umbrella or get my car or whatever." And you're like, "But it's raining. Can I go get it when the sun comes out?" They're like, "No, I need you to go do it right now." So they're going to go out here and they're going to get wet. So they're going to go out here and they're going to sell your asset, and they're going to pay what is called a big liquidity premium. They're going to pay a massive transaction cost to sell that asset. So I'm selling my commercial real estate in a down market. So that building that was worth 10 million, I got to sell it for 8 million because I got to get you your cash. And then everybody's losing money hand over fist. Like everybody's getting pummeled. And so ultimately, that liquidity risk, the problem with that, and the problem with the way the Trump administration is approaching this issue, is that the people that are sort of putting the money in the retirement accounts and the 401ks and the pension plans, they're not really signing up for all this. They're not signing up for the fund manager to take their money and put it into these low liquidity investments. And that is, I would say, unethical, because what it's doing is it's exposing people to a risk factor that they're not aware of, and also a risk factor they're not prepared to deal with. Right. So one thing I would also say for sure is that when you invest, keep liquidity in mind. Do not go and put money into stuff unless you're clear that, especially like private equity stuff, when somebody's like, "Hey, I've got this real estate deal I'm going to do," or "I want you to put money in this business I'm going to start," just know that your money's gonna be taken away from you and you'll probably never get the money back. At best, you'll get a percentage of some significant revenue stream. Your odds of getting all your capital back are slim to none, because they're gonna take that money, they're gonna put it into buying whatever they're gonna buy, and then you can come back and say, "Well, I want my $50,000 back," or whatever, and they're gonna be like, "Well, I don't have it. I can't sell the business," right? So this is one of the reasons why I think if you're a novice investor or you think you might need your money, it's better to go to like the public markets, because you can. If I buy a stock now, I can sell it tomorrow and get, a good market price for that. I don't have to pay a huge transaction cost. But if I go buy property, if I invest in parking lots or something with my cousin, or he buys a liquor store or something with it, it's going to be much harder for me to get my money back. All right. So let's move on. When you say you're buying into a stock carefully, what does that look like? It might mean that I just look into the industry, decide if I want to be involved. If I want to be involved, I'll buy shares consistently over time and do like a dollar cost averaging framework, which means that I'm going to just sort of buy a little more when the price goes down, and just hold long term. I don't buy anything unless I plan to hold it for the next 5 or 10 years. Or the only other time is I'll buy stocks because I want to get the income from them. I'm looking at it almost like collecting rent money or something to pay bills. That's the only time I'll buy stock. I don't buy a stock expecting it to go up the next month or two, because that's just, that horizon is just way too short. You can't tell a 10, 20 year story in 3 weeks. And that's another big mistake a lot of investors make, is they will look at a stock, over a 2 or 3 week period, and they'll decide if it's good or it's bad. Like people pick their stocks the way they pick their relationships. That's why nobody stays married. That's why families are broken up. You can't pick somebody to sleep with based on, you know, like 3 weeks of dating them. You should probably spend some time, get to know them. Think about it before you make the investment. I did that with my wife. I watched my wife as a person for a really long time before I married her.